The Taxation of Trusts, Part 1. Trusts could be established as a method of tax and estate planning. For example, marketable securities or listed shares can be transferred to the trust and they will hopefully grow. So they will grow in the trust and not in the person who donated or transferred the shares to the trust. Thereby, estate duty could be reduced. Then assets are sold or transferred to the trust and it's managed by the trustees on behalf of the benefit for the beneficiaries, but the trustee can also be a beneficiary. A trust has also been used to limit a taxpayer's liability. For instance, a husband could divert through a trust money to the spouse, his spouse or minor children. That money was supposed to be taxed in his own hands, but now it's diverted to those other parties, so reducing the tax liability of that father or husband. So there were certain anti-avoidance provisions brought in to try and curb this situation. And these anti-avoidance provisions are also applicable to other situations and it must be kept in mind. So the mechanisms of calculating the taxpayer's liabilities on the income they received or accrued to them from a trust, as well as the tax liability of the trust itself, will be dealt with. And special trusts and non-resident trusts are not covered in this presentation. The tax rate for a trust is 45%, but that excludes special trusts. The trust isn't entitled to any rebates or interest exemption, and persons that can be liable for tax in a trust can be the person that makes the donation, disposition or other settlement, or a beneficiary who receives income or incomes accrued to the person, or the trust itself. That's usually the income that's retained in the trust, but remember that we must always consider sections 25 and all the section 7s that can apply in these situations. And then there must be a donation, settlement or other disposition. So if a person sells an asset to a trust and receives the money and it's arm's length, then there is no donation. So it must be made wholly gratuitously or for no consideration, or there must be an element of generosity, or it must be an interest-free loan. The interest that the trust doesn't have to pay is regarded as the donation, or loans that aren't made at market-related interest rates. So for instance, if the interest rate for the market is 10% and the person that donates the loan only bears 5% interest, then there's a difference between the 10% and 5%. So that is deemed to be the donation. But in such a case also there must be an apportionment made, because there is 5% interest that's being charged. So the difference between the market-related rate, 10% and 5%, you can almost say that's 50% difference. So this person then should only be subject to 50% of the Section 7 income that's distributed to other parties. So that person, if the person made a completely interest-free loan and the market rate is 10%, then 100% of the income that's distributed to other persons could be subject to the donor's own hands and taxed in his own hands. So that's what the apportionment means. And there must be a causal link between the income and the donation. So if the person donates a block of flats on an interest-free loan to the trust, and that block of flats earn rental income, that is the causal connection. The block of flats was donated and rental income is received from it. The sections that will be covered in part 1 is section 25b1 and 25b2, section 7.1, 7.2, 7.2a, 7.3, 7.5 and 7.8. Part 2, section 7 cap C, section 7 cap D, paragraphs 68, 69, 70 and 72, and paragraphs 73 and 80 can be read. Section 25b1 deals with vested rights, but it's always subject to the section 7 provisions, so you must always go look whether that could apply. So the beneficiary has a vested right to the income, but it's not applicable to capital amounts that are not included in gross income. So if that's the case here, then the beneficiaries are taxed. Section 25b2, it's also got to do with a vested right, and it's also subject to the section 7 provisions. But this deals with a discretionary trust, and where the trustees exercise their discretion in favor of a beneficiary, that income vests in that beneficiary. Then the beneficiary is taxed. Section 7.1 also deals with vested rights, but it's also subject to sections 7.2 to 7.8. So one must look at those provisions. The trust deed will determine the beneficiary's vested rights, and it can be in income and or capital, and whether an amount is received by the beneficiary, so it was paid, or it has accrued to the beneficiary, so it was not paid but it accrues, those amounts will be taxed in the beneficiary's hands. And if a beneficiary dies and the income accrues to the beneficiary's estate, that is also a vested right. Even if a condition is not met, for example, the beneficiary didn't attain a certain age. So let's say the beneficiary would not have received any vested rights until the age of 30, but if the beneficiary dies before that age, it vests to the estate. So that will also then be a vested right. Section 7.2, spouses. So there must be a donation, settlement or other disposition by a spouse. You'll see in section 7.1 this requirement wasn't necessary. Then the spouses can be married in or out of community of property, it's irrelevant. And one spouse makes the donation and the other spouse earns the income that relates to that donation. So income is diverted from one spouse to another. And the sole or main purpose of this donation must be the reduction, postponement or avoidance of a tax liability by the donor spouse. So if this requirement isn't met, then section 7.2 won't apply. And then out of proportion income, it's excessive income to other spouse from the donor spouse's trade. That excessive portion will be deemed the donor spouse's income. So for instance, if they have a business together, husband and wife, and the wife's market related income should be, say, 20,000 Rand per month, and the husband says, no, let's pay you 100,000 Rand per month, then that 80,000 Rand excess will not be taxed in the wife's hands, but in the husband's hands as well. And that's why it's taxed in the donor spouse's hands. Section 7.2 Cap A, it's for spouses that are married in community of property. If only one spouse has a trade, the income from that trade will accrue to that spouse. If the spouses trade together, then the income must accrue to each spouse in a reasonable entitlement proportion. If it's not reasonable, the excess accrues to the other spouse. It's in the previous slide, that example given of the wife earning should earn 20,000 Rand, but she earns 100,000 Rand, so that excess of 80,000 Rand will be taxed then in the husband's hands. Then the letting of fixed property, it's deemed to accrue to both spouses in equal shares, so it's 50%, 50% each. The same with non-trade income, for example, interest and dividends. It's also deemed to accrue to both spouses equally, 50-50. Section 7.3, it's between parents and minor children. So there must be a donation, settlement, or other disposition by the parent, first requirement. So the income received by or accrued to the minor child or stepchild will then be deemed to be that of the parent that made the donation. And a minor child is someone that's under 18 years of age and was not married or divorced or widowed. So if they were married or divorced or widowed, they're not a minor child anymore, even if they are under 18 years of age. And section 7.3 is also not applicable between grandparents and their minor grandchildren. Section 7.5, there must be a stipulation or condition in the trust deed. There must be a donation, settlement, or other disposition that was made by any person and which is subject to a stipulation or condition or the happening of a future event. So all income that accrues to the trust before that event or condition is met, the income will be taxed in the donor person's hands. So when the condition is met, say for instance, a beneficiary obtains a degree, then the section 7.5 will not apply to that money afterwards that vests in the beneficiary. Section 7.5 is also not applicable to vested rights under section 25 Cap B and section 7.1 unless section 25 Cap B or 7.1 is subject to either section 7.3 or 7.8, then section 7.3 or section 7.8 will override section 25 Cap B or 7.1 and they will apply. So they must be taken into account then. And section 7.5 mainly applies to income that was not distributed by the trust. So it's still left in the trust. And another requirement is that the donor must still be alive. Section 7.8, it's distributions by a trust to a non-resident. So there must be a donation, settlement, or other disposition by a resident to the trust. And the income received by or accrued to that non-resident will then be taxed in that donor resident's hands. And the section 10B 2A, foreign dividend participation exemption, that's where a person holds 10%, at least 10% of the equity of the foreign company declaring the dividend, then it's fully exempt, will not apply or must be disregarded unless the non-resident that receives the dividend alone or together with a connected person holds more than 50% of the declaring company's voting rights, and the non-resident is a connected person in relation to the resident donor or any connected person in relation to the resident donor. So this concludes part 1, and we'll talk again further in part 2 about section 7C, 7D, and the effect of capital gains in a trust. Thank you.